Hey folks, so I'm going to do some analysis on after the first round in CAPSim. We're all on teams, and to protect the innocent, I've gone ahead and scrolled down so you won't see their names, and you won't see my name on there either, but that's okay. I'm Bob. Let me go ahead and show you the results. All right, here we have the return on sales. You've got all these numbers across the board, and this is the one that kind of stands out over on Digby. They did a good job. I was surprised by that because they'd done poorly in the earlier rounds. But if you take a look, they did very well this time. The turnover, Andrews ended up on top there, so they did a good job selling their material. Let's see, looks like Andrews borrowed some, Erie borrowed some. Sales, as far as sales numbers were concerned, looks like Andrews came out on top, and Chester came out right behind him. The earnings before taxes, before income taxes, is 6.5 million, 6.8 million, 6.8 million. So it ended up being that Digby ended up making more earnings before taxes than everybody else. So that's interesting. The higher sales, but more earnings for Digby. So we'll take a look at that here in a second. As far as the profits, Digby got 3.9 million, 3.5, 3.7. Those are pretty good numbers. I'm not going to pay attention to Erie or Ferris because those are just computers anyway. Contribution margin. Looks like so far Andrews has the highest contribution margin, which means they probably put some money into their automation. So we'll take a gander at that too. The biggest thing to concern yourself when you're finishing the first round of CAPSim is to have the highest market share. So right now Andrews has 19.53, Chester 19.16. Even though Digby did pretty well on that one, their market share is actually fairly low compared to the other two, being 3% behind almost. And that's going to be, as you go on through the game, it's a little bit harder to keep up with that market share as long as you don't stock out. The other companies don't stock out. It's pretty hard to catch up. So here with Andrews, we ended up with stock price at 16.55, 1 cent above Chester, and then Digby came out on top. And so that stock price, as you can see, has a lot to do with their earnings before the taxes and their cumulative profit. See, their cumulative profit right now is higher than everybody else's. So that's going to have a lot to do with it. Let's see what else they did. Let's see. So Digby did not sell any shares. So that's going to help them with their stock price. Whereas Chester did. They sold some shares to make some money for some of their decisions. And Andrews did not sell any shares. That also keeps their sales price up. When there are a few shares available and there's similar profit amongst companies, your share price is going to go up. That's earnings per share is going to have a lot to do with that. So all that looks pretty good. Here's the credit ratings. I'm not too terribly worried about those. It doesn't really matter too early in the game. So you've got your net income. Andrews 3.5 million, Chester 3.7, Digby 3.9. I'm focusing on the big guys right now. Plant improvements. All right, so Andrews put in 6.9 million, which is about the max that you could. Digby put in 5.6, so they weren't investing too heavily in their place. That's going to come to bite them later on, I think. Chester put in 6.8. That's really good. They came really close to Andrews there. Andrews borrowed 2.4 million from long-term debt, $1,000 from short-term debt. Looks like Chester took 4.1 million and they sold stock, but they didn't want to do long-term debt. That's interesting. And then Digby didn't take any debt whatsoever. Also very interesting. So that's probably why they don't have any debt payments that help them out with their profit. All right, so here's the cash at the end of this round. So it looks like Chester's going to have a little bit more cash than everybody else. We'll see what they do with it. Digby's going to have a little bit more cash, and Baldwin's got he's there in second there as far as the cash holdings. Plant and equipment, it looks like because of the investments, the Andrews is on top. That's going to come to help them out. Accounts payable. And where's accounts receivable? Okay, so these are numbers you guys really want to pay attention to, in my opinion. Accounts receivable, look at that. Andrews at 5.2 million, Chester's at 6.6 million. What this means is that these people have adjusted their accounts receivable to be more days than typical. So instead of having a 30-day accounts receivable, they bumped it up to probably 35 or 40 days, giving the customer basically more financing time where they don't have to pay the day that they buy their product. Digby did not do it, and neither did Baldwin. It looks like they didn't even touch it, would be my bet. I bet Chester moved it, though. I guarantee it looking at those numbers. They moved theirs. Inventory. So they did a really good job at forecasting how much inventory they would need. Andrews was over. They went a little bit too high, and so that's what cost them there. If they'd have been lower, probably a couple their inventory they'd have been fine. Plants and equipment. Accounts payable. So if you lower your accounts payable, as Chester did here, you can see that, and so did Digby, the faster you're able to make your equipment and the cheaper it might be, the better your contribution margin. It doesn't look like Andrews changed theirs, and it looks like Baldwin may have lowered theirs. It's quite possible. They might not have changed it at all, just with the amount of product that was sold, but I'm betting Chester lowered their accounts payable. That's going to help them later on in getting their products made and having their parts on time. And accounts receivable increased demand, so you can sell more stuff. Common stock available, so they've got more. These two are the ones that didn't sell any common stocks. Theirs is going to be lower. Retained earnings, so those are all pretty normal for the first round. Pretty good. So here are the sales. So Andrews ended up on the top as far as sales numbers, total sales, but they had some higher costs. Digby ended up with 47 million. See here the variable costs. See there, Andrews had 40 million in cost. Digby only had 35 million in cost. And Baldwin actually, look at that, a little bit less than 30 million. So not too bad, but they didn't sell as much. Here's the taxes. Chester paid quite a bit in taxes. Digby paid a bit in taxes. So all in all, not too bad. Digby ended up with more cash at the end than everybody. Everybody ends up with production capacity. Andrews was producing, had huge capacity. They're going full bore. Here you go. So Able, they dropped their NTBFs. That's how long it's going to last, to 18.3. That looks like that was to lower their material cost, the $11.97. This is a key place to look, guys. You can see how many units were built. So in this case, Able built 1,567 parts and had 69 left over, which is surprising that was so expensive based on their inventory carrying costs earlier. Baker, they were trying to produce about 1,300 parts, and they overproduced. Cake did 1556 and only had 12 left over. That's fantastic. Days, which is Digby, only had 27 left over. Also fantastic. So good job in their forecasting. It really saved them some money. Overall, the three did great. Baldwin was a little bit behind, but let's take a look why. So we have Cake, Chester's at $34.59. So their price was cheaper than Andrews. Their material cost was much higher. Their labor cost was lower. They didn't produce as much, that's why. You can see over here plant utilization at 185%. That means they weren't trying to produce as much, so they didn't pay as much in labor. So you have 96% overtime versus 86% overtime. It doesn't always pay to have full bore on your units unless you know you're going for market share. Contribution margin, it looks like Able is actually able to eke out. Andrew's got a higher contribution margin, which means it costs them less money per item than these other folks. Days, Digby did 24%, so that's interesting. Only 63% overtime, so they're really keeping their production low. But look at this. Next round, Baker spent nothing on increasing their capacity. Digby increased theirs by 200, so they're really expecting to take over the low market next time. They're going to have a high capacity. Looks like Andrews went up 50. They have another product with 400. Baker has 300 and 250. Now these, you can tell by looking at these, these are all going to be high-tech products. With Amoeba coming out in 5.9, Big Ben 6.3, Crunch 4.19. I'm betting that Big Ben is going to be right on the leading edge, and they're going to have high MTBFs, which is what takes them longer to do this. As far as, look at this, so they didn't change their product at all. Days did. They actually lowered their size. They made their size smaller. So that's interesting. That's curious. They went 6.8 and 13.2. So it looks like they're trying to go in between both the low market and high tech. Able went straight down to 5.5, 14.5. That tells me that they're going to go straight low tech. That is a straight low tech, which means this is definitely going to be a high tech product coming out. So it's very interesting. You can see as far as automation, you've got Big Ben coming out with automation at 3.4. If that's a high tech product at 3.4, it's going to take them longer than normal to keep updating that product, but it will be cheaper for them to use. So you're going to see low tech, cheaper product for Able, cheaper product for Cake next time. They went way up there. And I would bet that for the high tech market, Andrews is going to take over market share there. Big Ben, they're going to try. They're going to do pretty well, I think, because I think they're going to have a top-notch item. And then Crunch is going to try as well. But Digby, they're pretty much stuck in the low-end market because they didn't introduce a product this time. So you can learn a lot from this screen, a whole lot. See what we got down here. Yeah, Andrews pulled ahead there in the market share. So this is interesting also. It shows you what their potential market share will be. You can see the size, the age. In the low-tech market, it's important that you take a look at this price range. This is how much importance the customer puts on that price range. Obviously, the closer you get to the $15, the more important it is for the customer, which means the higher chance of gaining that market share. But you're going to also have to be on the upper end of MTBFs. If you had 20,000 MTBFs at $15 and at 3 years of age, and you're right on 5.3 and 4.7, you would sell every single product. That's what this means. Now, the other thing to keep in mind is there are only 5,544 products that are going to be sold that were sold this year. Next year is going to be 10% more, which is only 550 more, which means next year there'll be 6,000. That's important to keep in mind. Here we go. So Able sold 1,152. As far as forecasting next year, that means they need to say they're going to sell 1,152 plus 10%, which is 115. So they better stock 1,262 or so, at least for the low-tech market. And you'll see some more for the high-tech in just a second. They put in a lot into promo, put a lot into sales. So their awareness is the highest. Their sales budget, they were able to have access to their customers, was the highest. I think that's why they got market share, because of that. Cake was right behind them. If you remember, their market share was it was right behind Able. So they put in quite a bit. They made it accessible. They made it made people aware of it. They got a lower price and a higher MTBF. That higher MTBF is really what captures some people's attention too. Let's see here. Digby, where are they? Right down here. So the only one that didn't change the age was Baker. So age, even though it's important, wasn't as important in this case as some of these other people did. So we got days at 2.39, 1,200 and 1,000, so a million and 1.2 million. So they paid a little bit less in their sales budget and promo budget. They put their money into automation and capacity, some other things. So that's interesting. They made their size a little bit smaller. All right. Let's take a look down here. So here are the expectations. There are only 2,500 parts that are sold this year in high tech. And there's only going to be a 20% increase, which means there's going to be 500 more. So 3,000 total are going to be made. That's important to take a look, because as people put out high-tech products, those are going to take the brunt of the market share. So we used Able last time for the 10% increase. Well, they sold 416 in the high-tech. That means they had another 80. So it should be 490. So basically 500 plus about 1,300. So they should be producing about 1,800 for the low-tech and the high-tech market together. If these were the only products that are out there. We know 3 more products are coming out, so they don't have to do quite that much. Who was on top here? Cake was, and let's see why. They have a lower price, high MTBF. That's what the high-tech people are going for. They love that high MTBF. Let's take a look here. High MTBFs, that's 13% of what they're looking for. They're on the top as far as that's concerned. The price, 25 to 45 bucks. Well, shoot, Cake did it. Chester's team did it, 34.59. So they were essentially the lowest, other than Eat. But compared to Eat, Cake's performance is much higher and their size is much smaller. So of course people are going to go for that one. As far as age, they're all about the same. Age, the Baker's the oldest, so of course they were last. So that didn't help them. And the sales budget was pretty good for these guys. So it looks like Cake took it because their performance was good, their size was pretty small, and their price was lower. And they had high MTBFs. That's really what it comes down to in my opinion, my analysis. So Chester has the high market share for the high tech, and that's going to be a high priced area later on. So that's actually not a bad way to go to corner that high tech market for sure. All right, so here we go for the next round. This is what the sheet says, is that the potential market share for low tech, Abel's at 20.8, and for the high tech 16. Jump down here to Cake, it's 18.3 and 21. Now this is going to be interesting. Digby, they're predicting about 15.1 and 19.7. I have a feeling that Digby is going to get beat out this round because they did not produce another product. That's really going to be their downfall, in my opinion. It could be they're planning on one for the third round. If they don't have one in the second round, I would definitely put one out the second round. For the others, I would probably hold off the next round, not produce one, and save it for the third round. See what happens. Here's the people that were hired. Turnover rate's pretty good. Productivity is at 100%. Not a whole lot that you do in this first round. Let's see, recruiting costs, all that cost was because of the overtime. Yep, that looks pretty good. And these numbers haven't changed yet. Ethics haven't come into play in round one. So this is the deal. I think there's a pretty good competition between Chester, Andrews, and Digby. I think Baker needs to step up their game. I think Digby needs to come out with a high-tech product because they aren't there yet, and they kind of really hurt themselves. Baker will need to make an adjustment to their product this round for the low tech in order to get the age right. They're already at 4 years, so they'll need to bounce it down to 2 plus the year, so that put them in good with the age limit. Abel and Chester, I bet, are coming out with a high-tech product. I believe Baker is as well. And if they price them right and they have the right NTBFs and whatnot, it's going to be pretty good competition. Yeah, it'll be interesting to see what happens next round. Good job, guys.